corporate reconstruction as well. And the third is risk management. Risk management. Yes. So the risk management. So in this way, we can divide the whole syllabus into three parts. Yes, into three parts. We divide the whole subject. Now, the point is, additional, yes, there is some theoretical topics as well, which are related to international trade, which are related to risk, treasury, etc. But three major areas. And when we say three areas, and we know that there are three questions in the exam, so they are equally tested. They have equal weightage in exam. These all topics have equal weightage in exam. Means they can be tested for the same marks, equal weightage. Now the point is, advanced financial management. What is the most important? Students, first of all, there is conceptual knowledge, which you should have. Conceptual knowledge should be there. You should have that. Then after that, you need to practice calculation. Wait, what it is? Yes, you need to practice calculations part, and along with that, then learn and practice practical questions. Normally, what happens? Students, they do not actually focus or pay heed towards theoretical topics. Now, so students, the point is, now theoretical topics, when we talk about that, theoretical topics are, the questions are, they are of two types. They are of two types. The one is one question which is related to calculations. The topic which is related to the calculation. The one. And the second is, which, yes, there are theoretical questions which are related to calculations. So means that you will do calculation and then you will be able to solve it. And the second is, those questions independent theoretical question, utilizing information from scenario as well. Yes. So here we are. So we have to prepare. Remember, we have to prepare all these three things. Okay? Yes, we need to learn and we need to work on that. So let us proceed further. Let us proceed further. Students, we will be starting with, let me share with you the lecture plan. Here is the lecture plan. I have just not allocated dates. Dates I will allocate. But I have prepared this lecture plan, which I'll be sending you once I put the dates here. So starting with the advanced investment appraisal, we will be talking about it in the next 6 lectures. Next 6 lectures we'll be talking about it. And then later on, we will be moving towards merger acquisition and reconstruction. And then the last will be risk management. I have planned 21 lectures. And if we count Sundays from today till the end of, if we count, they are basically 17 week ends. From January to April end. And I want to complete your syllabus by April end. So it means weekends. So that means we need 4 additional classes. You need 4 additional classes. So, and you see here, there are 3 tests scheduled. Test 1, test 2, and test 3. And then I will be arranging mocks, full course mocks. I'll be arranging that. So, student, here are the mocks in front of you. Now, so let us proceed further. So we will be starting discussion on advanced investment management. These tests are very much important. These tests and these mocks will keep you on track. They will keep you on track. I'm telling you. Now, so let us start with investment appraisal techniques. Any question so far? Yes, one thing I forgot to tell you, that is what resources we will be using. The resources which we'll be using, they are study notes. The notes I will provide, they include all the aspect of the syllabus. Study notes. Then I'll be providing you the second thing, that is we will be doing practice. From Kaplan exam kit, I'll be providing you. We'll be doing that. And if needed, of course, for the practice, I suggest to you, yes, the latest 4 past exam papers. They are important to be covered. Okay, so this is what we will be following here. Now, students, the topic is investment appraisal. So in the investment appraisal techniques, investment appraisal techniques. When we talk about, there are multiple investment appraisal techniques. The first is payback period method of investment appraisal. Okay, what are the part of your syllabus? I have listed those investment appraisal techniques in your, yes, accounting rate of return, discounted payback, and NPV, IRR, MIRR, and duration. So these are the investment appraisal techniques. 7, which are part of our syllabus. We have to study all and learn their application. For each technique, for each technique, what we need to learn? We need to learn, number 1, the meaning and of the technique, meaning and calculation. Interpretation of result. How to interpret the result. How to interpret the result. And the next is advantages and disadvantages of that technique. Yes, this is what we need to learn for each technique. And of course, complexities are there. They will be there in the calculation. Of course, we need to work on those complexities. Now, so let us, it is opened. Okay, we need to start with accounting rate of return. Why I am typing here in the Excel sheet? I have my iPad with you to write about. So then the reason is that I will be using throughout your session Excel sheets, spreadsheets. The reason is quite, that you have to, what we say, in exam, you have to use spreadsheets to write your answers. So that's why we will be using from the day 1 the spreadsheets. Remember that. Now, so students, accounting rate of return, ARR. It is also called ROCE, return on capital employed. Return on capital employed. It is basically annual average percentage return on investment. It is basically average percentage return. The most familiar concept, that what a business is earning. on investment. Now, so students, for example, there is an investment in a project, initial investment, that is, for example, 200,000. Yes. Okay. Yeah. And scrap value will be at the end of the project, that will be 15,000. And expected profitability in year 2, year 3, year 4. So profits expected, they are 45,000, 47,500, 32,400, and 29,500. Yes, these are the profits. Now we have to calculate rows. How to calculate? So the formula is ARR or rows is equal to average annual profit divided by average investment. Divided by average investment. Average annual profit divided by average investment. So what is average annual profit? How it is calculated? Okay, first of all, average investment. Let me tell you about that. That is equal to initial investment plus scrap value divided by 2. Yes, these are the formulas you should have command over. So average annual profit, how it is calculated? Students, we calculate sum of all these divided by number of year, 4. Sum of all profits divided by number of year, 38,600. Average investment, initial investment plus scrap value divided by 2. Average investment, same formula applied. Now, accounting rate of return, ARR, average annual profit, average investment. This formula, average annual divided by average investment and percentage, 35.9%. This is accounting rate of return. Here you go. Is that clear so far? Tell me, please. Good. All right. So accounting rate of return we have done with. Now, so this calculation, one more example we will talk about for better understanding. For better understanding. Remember, this is the only investment appraisal technique which is based on profits. Based on profits. Only investment appraisal technique. All other techniques, they are based on, I told you, these are the techniques. All other are based on cash flows. They are based on cash flows. So students, for example, what is the difference between cash flows and profits? Cash flows are basically the cash inflow and outflow of the company. Cash inflows and outflows of the company. So cash flows, and if we deduct from non-cash expenditures, non-cash expenditures are, for example, depreciation, provision, amortization. Mere company, these are non-cash items. When we deduct that from cash flows, what we get? What we get? We get then profits. Cash flows minus non-cash expenditures. What we get? Profits. So, sometime in exam, so this formula, we should, of course, they should be our fingertips, these formulas of accounting rate of return. So I'm going to write another example. Yes. And another thing we learned, yes, we learned another thing. Now, the next point is, for example, example 2. Company has initial investment done in a project of 22 million. Okay, make it, yes, like this. Yes, 22 million. And scrap value of investment at the end is expected to be 2 million. Right, 2 million. Life of the project is 5 years. Yes, that is the 5 years. So here are the cash flows of the project. Year 1, 2, 3, 4, and 5. 5-year life. So 5-year cash flows. That is 4.5 million. Yes, for our ease. No, it have become 45 million. Yes, 4.5 million. Then is here it is 7.5 million. Then here it is 6.5 million. Then here it is 8.5 million and 8.9 million. Yes. So these are the cash flows. You will get this Excel sheet. I'm telling you. I will provide you. Don't you worry. Okay. So these are the cash flows of the project, including all the cash flows. We need to calculate ARR. And in order to calculate ARR, we need profits. We need profits. This is the formula we will utilize. Students, we have cash flows. We need non-cash expenditures to get profits. So here, non-cash expenditure is depreciation of the investment. Initial value of the investment was this. When the business started, this was the investment. Then scrap value at the end of the project is here. Scrap value at the end of the project is here. Initially investment, scrap value. Difference is depreciation. This was so this is the total depreciation throughout the life of the project. Total depreciation. So you see here total cash flows. So we will calculate sum of the all cash flows. Just added all. Now we have depreciation. So profits we can calculate. Total profits. We can calculate profits utilizing this formula. So profits is equal to cash flows minus I hope it is clear. So average annual profit. So this divided by total profit divided by total number of years. 5. Average annual profit. Number of years are 5. Average annual. So average investment. Initial investment plus scrap value divided by 2. Initial investment plus scrap value divided by 2. Here is the average investment. We have average annual profit, we have average investment. So ARR we can calculate. Yes, average annual profit divided by average investment. Now, so here it is. So 26.5%. If there is any issue, do let me know. The next point. The next point is, okay, let me give you a question. Initial investment in the project, that is 500. Scrap value will be 5,000. And cash flows, your one, two, three, and four. For your life, cash flows are 25,200, 27,500, 27,700, and 28,000. Students, calculate and give me answer for ARR. Be quick. Calculate, please. Yes. Be quick, please. Calculate accounting rate of return, ARR. More answers, please. More answers, please. 37.1. Okay, different answers. Okay, let me do. So you see here, what is the depreciation? Depreciation is this minus this. 57,500 is the depreciation. Students, remember, you will always be doing calculation in Excel sheet whenever you are practicing. What I have observed in the last session, students are doing calculation on paper. No, in exam, you won't be using any paper. So total cash flows, first of all, these cash flows, profits, total profits. So cash flows minus depreciation. So average annual profit, this divided by 4. So ARR, average annual profit divided by, sorry, average investment we have to calculate first. Average investment, initial investment plus scrap value divided by 2. So ARR, average annual profit divided by this, 37.7%. This is the answer. This is the answer. Now, the next is, students, let us proceed further. What are the drawbacks and pros and cons, advantages and disadvantages? And disadvantages of this ARR. This method, I told you we need to learn this. We need to know this. Friends, the first is that it is easy to calculate and understand. Yes, it is. Based on profitability, which is familiar concept. That's it, nothing else. Disadvantages. What are the drawbacks? What are the drawbacks of ARR? This method of investment. What are the drawbacks? The first drawback is it is a relative term, and relative terms means tells answer in percentage and ignores the size of project. It is a relative term and ignores the size of the project. Relative, percentage. Now you see here, ARR is telling project A and project B. Project A has ARR of 35%. It has 27%. Which one we should go for? B. Sorry, A. Based on ARR. But ARR is not telling how much is the profit, amount. How much is the investment? It is not talking about that. What is the quantity? For example, here total profit is 2 million. And here is 250 million. So size is ignored, project size. ARR is not talking about that. It is not considering that. And then it ignores time value of money. Yes, no time value considered. It is based on profits which can be manipulated easily. Increased appreciation, decreased appreciation. Profit will be changed, or any non-cash items. Now, the next point is accounting rate of return is done. The next point is net present value. NPV. Net present. Sorry, before that, just a minute. We have to go payback period. Yes, we have not done that. Payback period method of investment appraisal. Today, some students are facing issue in joining the class on the portal. That's why 50% of class is still absent. I'm sorry. You people, whenever you face problem, there is one way. Immediately text to the coordinator. If you have any issue, text me. So when I started the class, I was upset. What happened? My classes, students are not here. It was quite shocking for me. What happened? Then I instructed coordinator to contact you guys. And he's texting the message you people. Payback period method. Payback period method of investment appraisal. Yes. So students, whenever investment is there, every business wants to know in how much time my original money, which I am investing in the business, that will be recovered. In how much time? Business is concerned with that. The first concern, that my initial original money which I'm investing, because sometime, for example, we are going to invest in a business, in a project, and the amount to be investment is $500,000. Okay. Now this amount I need to borrow from the bank. And the bank is giving me loan for a 5-year loan. What is my interest, first of all? That whether the project, I have to return this money in 5-year time. Whether the project I am going to invest in, that will return money in 5 years. That will return money in 5 years or not. This is my first interest. The first desire. I need to check that. So payback period method. So payback period, the time period, it measures the time in which initial investment of project will be recovered. Initial investment of the project will be recovered. It measures the time in which initial investment of the project, payback period, will be, and the business is concerned with it. So students, for example, a project has cash flows year 0, 1, 2, 3, 4, and 5. Initial investment is, for example, negative 750,000, and the cash inflows are expected to be 245,000, double 3, 30,000, 129,000, and 214,500, 189,000. These are the cash flows of the project. These are the cash flows of the project. We need to calculate payback period. So we will make another cumulative cash flow column. Cumulative means total to date. So total to date, negative this. Next year, this plus this. So 245 is recovered, remaining negative, this. Next, this plus this negative. Here you go. This plus this. So 3 years. Now you see here, it will be settled down in year 4. In the part of year 4. Full year 4 is not required. So 46,000, how much part of year 4? What we need? 46,000 we need. And what is the money here? Here, this. So we are getting this percentage. So 3.21 years is the payback period of this project. This is the payback period of this project. So 3 years. And how many months? If we want to calculate months, 0.21. And we know that there are 12 months in a year. Multiplied by 12. So 3 years and 3 months. What I have done? I have multiplied 0.21 with the 12. 3 years and 3 months. This is the payback period. Now, so students, yes. Payback period method, what are the advantages? It is cash flows based, which are more reliable than profits. It is cash flows based, which are more reliable than profits. Second, the second point, it is it ensures liquidity of the company and reduces risk by recommending projects with shorter payback. Yes. So it says accept those projects which have shorter paybacks period. Accept those projects. So when shorter payback means earlier, risk is low. It lowers the risk, but it has drawbacks as well. What are the drawbacks? Drawbacks. Now focus here. It ignores time value of money. Yes. First of all, second is that it does not consider full life of project and ignores the cash flows occurring after payback period. I will explain, don't you worry. What does it mean? The meaning is that what is happening after year 3, 4, 5, it is not its concern. For example, two projects, project X and project Z, they have 3-year payback period, both. Now, but year 4, year 5, it is giving, project X is giving, for example, 15 million and 20 million. And it is giving 3 million and 7 million. Now, payback is not concerned what is happening after 3 years. Because it does not consider full life of the project. So it is drawback. It only concerned that, okay, when the initial investment is recovered, that's it. End. Next. Students, it encourages, yeah, just a minute. It encourages excessive investment in short-term projects and ignores the long-term growth of business. It ignores the long-term growth of the business. Now, the next point is the next point is here comes the discounted payback. period method, which actually removes this drawback. The first one, this one. So actually, how discounted payback is calculated? I will take all these cash flows. The same question I will take. And I will simply 229, 274. Yes. These are the cash flows of the project. Cost of capital is 10%, for example. Cost of capital or discount rate is 10%. In the discounted payback period method, we calculate present value. What is the formula of present value? Is equal to future value into 1 plus R, discount rate, raised to power minus N, F3, F2. Future value, 1 plus R raised to power minus N. So just see here. Future value into 1 plus R is 10%. Raised to power minus N means number of year. Just see here. Try to understand it. Now, here we are. Simply drag it. Apply the formula. So present values we have calculated. We have calculated present values. I hope it is clear because all of you are using Excel sheets in your workplaces. Cumulative cash flow column. We were making this cash flow column cumulative for this cash flows. No, but here we will make it for present values. That's why it is called discounted payback. This plus this. This plus this. This plus this. So 3-year full. And part of year 4, 82494 divided by 187,487. 3.45 years. 3.45 years. Here it is. $3.45 years. This is the discounted payback. So this drawback, ignoring time value of money, has been resolved. It has been resolved. I hope it is clear to you people. Now, the next is, but still, it does not consider life of project, ignore cash flows. Here comes the duration. The concept of duration. What is duration? Duration is a new concept you have not studied before. Okay, I need to ask a question to you people. Yes, just a minute, please. Yes, please select that option. There is a small poll in front of you, please. Be quick, everyone. Here is a small poll in front of you. Really? What is happening today with the Zoom? I think there is a problem with the Zoom today. I think that because that's the reason students are facing problem in the morning as well. Anyways, okay. Others, anyone else who is not seeing the poll? Tell me, please. Okay, because a few people attempted that. Okay, anyways. So duration. Duration is a new topic. You have not said it before. Duration is basically weighted average time to recover cash inflows from the project. Weighted average time. Weighted average time. Just a minute. Yes. What does it mean? I will talk about it. We will learn it. For example, a project has, so, cash inflows. So we ignore investment here. For example, I say year 1, 0, 1, 2, 3, and 4. A project has investment of 250,000, 35,000, 40,000, 120,000, 230,000, and year 5 as well, 190,000. Okay, this is a project, cash flows. They say calculate duration. Cost of capital is 9%. For example. Now, what we do, we ignore investment in it, in the duration. We ignore. Now, you see here, first of all, we need to calculate present value of cash inflows. Starting from is here, return phase, basically. This into 1.09 raised to power minus this. Same formula, this one. And we simply drag it. This formula, apply it. So total present value of cash inflows. So we calculate sum of all. Present value total. Now, weighted average. This divided by this. This divided by this. I will explain. Don't you worry. Very easy, called steps. You just need to memorize the steps. What we did, calculate step one. I will write here. Calculate present value of cash inflows. Yes, from return phase. Second, calculate total present value of cash inflows. Next, third, calculate, divide each year present value with total present value. And now four, multiply weighted average, each weighted average with relevant number of year. Yes, you see here. Now what we'll do? This multiplied with this. Relevant number of year. So automatically applied. What happened to it? Just this divided by this. Yes. So what we did? Each weighted average with the relevant number of year. Now duration. Sum of all. So 3.7 is the duration. You see. Now, one more question to grasp this concept properly. The next point is example 2. 0, 1, 2, 3, and 4. Negative 120,000 cash flows. 32,000. Make it 75,000 and 69,000, 15,000 and 10,000. Cost of capital is 10%. Students, calculate duration. Be quick. Calculate duration of the project. Follow these steps and calculate. Be quick. I'm waiting for your answers. Yes, please. Be quick. I'm waiting for your answers. Calculate duration. Right. All right. So I have received some answer 1.7. Okay. I will calculate myself. So first of all, present value of cash flows. This into 1.1 raised to power minus this. Total present value. Here you are. And weighted average. 6818. Yes. Why to type when we can link the cells? Yes. This divided by this. Yes. Multiply with relevant year. This into this. Sorry. Yes. Duration. One 1.7. Good job. Now, students, now interpretation of the result. How to interpret it? What does it mean? It is weighted average time to recover present value of cash flows. Now, you see here, listen. If duration is, I will write here, I will write it here. If duration of a project is less than half of project's life, it means majority of projects cash flows are occurring in earlier year of project, the project life. And if duration of project is more than half of project's life, it means majority of projects cash flows are occurring in later years of the project's life. Yes. So you see here, 1.7 means the majority are occurring in the earlier year. You see here, clearly indicative. In the later years, less than half. Half means 4, less than 2. 5, 2.5. It is 3.7. It means majority cash flows are in the later years. Is that clear to everyone? Is it clear? Now, advantages and drawbacks. Advantages. Cash flow based, considers time value of money, considers full life of project. What is drawback? Only one drawback. Yeah, two drawbacks. One is it fails to relate projects return with investment. Fails to relate. No linkage with that. And it is difficult to conceptualize. Difficult concept. Difficult to understand. Now, so duration is done. Now, students, the next topic is net present value. Very easy. We know that what is NPV? Net present value. Net present value is basically, it measures the impact of a project on shareholders' wealth is called NPV. So we calculate NPV is equal to present value of cash inflows minus present value of cash outflows. Present value of cash inflows minus present value of cash outflows. So if NPV is positive for a project, is positive, what does it mean? We say accept the project. Why? We need to discuss it now. Why? Any one of you have any answer to this and would like to contribute? I'm all here. Because NPV concept you have been studying since long, F2. And if NPV is a negative, reject the project. Why it is so? Any idea, anyone? Any one of you want to contribute? Yes, students. Anyone, any idea, please? No one wants to contribute. Open your mic, talk to me. I'm all here. We said impact. Okay, thank you. Thank you. You contributed at least. So NPV is positive means that after payment of all costs, variable cost, fixed cost, everything, and then initial investment is also paid, I still have something in my pocket. The example is that I, take loan or investment in a project, then I run the project, I pay all routine costs. And at the end, I pay the initially borrowed money as well. Now still I have money in that account. It means now that money belongs to me. Initially that bank account was empty. Nothing was there. No, I have paid everything. Still there is money. So my wealth has increased by that money. So this is called NPV. That after payment of all expenses, initial investment from the project, there is some extra wealth generated by the project, which now belongs to shareholder. That's why I say, if present value of cash inflows minus all outflows, everything, still there is something positive, that is increase in wealth. But if negative means that project is unable to pay its cost, unable to pay its own investment. So that is a negative. So there is shortage, deficit money, which shareholders have to pay from their own pockets now. For example, our company has to pay. That's why I say negative, it will decrease the wealth. If NPV is positive, so positive NPV means means shareholders' wealth will increase by that amount. And NPV means that's why I accept the project. Negative NPV means that it will reduce that shareholders' wealth. Reject it. Do not go for it. Is that clear now to everyone? How impact of a project on shareholder wealth? Is that clear to everyone? Tell me, please. Hello, people on silent mode. Now, thank you. Let us proceed further. So, students, let us take some example and learn NPV. Let me copy this question. These are the cash flows of a project. Investment is 110,000 initial investment. Cash flows. Cost of capital is 12%. We need to calculate NPV. So present value is equal to this. Sorry, it is 110,000. Yes. Equal to this present value. Future value into 1 plus R, 12%, raised to power minus this. The same formula. NPV is equal to sum from here to here. So positive 29,002. 3. Positive NPV means that project actually paid all cash inflows, outflows, and then cost of capital, and then paid this amount. At the end, still in the pocket is this. Now, so positive NPV, it should be accepted. Simple is that. Another example. Yes, I will pick this. Now, investment is 350,000 negative. Yes, cost of capital is same. Cost of capital 12%. So present value is equal to this into 1.12 raised to power minus this. Yes, so NPV sum from here to here. Negative 55,000. Project is unable to pay its own costs. Project is unable to pay its own costs, its own investments. So we should reject it. I hope it is clear. Next, so NPV, advantages of NPV method and disadvantages. Cash flows based, yes. Considers time value of money, considers full life of project. It is an absolute measure and tells and considers size of project. How much is the wealth? Absolute measure means give answer in quantity. This will be the wealth will be decreased. This will be the wealth will be increased. ARR was saying percentage, relative measure. Okay? Absolute measure, telling the quantity, talking about what will be the exact impact on shareholders' wealth. Now, next, what is the drawback? Again, for business managers, it is difficult to understand. To understand NPV concept. Yes, difficult, which are non-finance people. So, student, there are some more advantages which I will talk with comparison in comparison with other techniques. The next topic is internal rate of return, IRR. Internal rate of return, IRR. But I will talk about it after a break of 8 minutes. Okay, let us take a short break. 8 minutes, we'll be back. And then we will continue IRR and MIRR. So today's task, the next two techniques as well. So see you in 8 minutes. Yes, students. Now, the topic is internal rate of return, IRR. So, internal rate of return is basically it is return of the project percentage return from annual from the project. What project is yielding, returning on average, IRR. You may have studied the other definitions as well, but I am teaching you in another way. IRR is return of the project. That how much percentage this project annually will be giving to us. Now, you see here, for example, we take this cash flows, right? We have to calculate IRR. IRR formula need not to be memorized. And now the life is easy at P4, Advanced Financial Management. You simply apply formula IRR and select all cash flows. Here is the IRR. Here is the IRR of this project. Simple. Another project. Its IRR. Internal rate of return. Equal to IRR. Starting from here. 29%. Yes, 29.1% IRR. So project is effectively giving on average annual base 29.1%. It is, if we say yes, average, yes, better word is average. Average percentage, 29%. Now, you see here, we say that if internal rate of return is greater than cost of capital, we say accept the project. We say that. Otherwise, reject. Otherwise, reject the project. So, the point is, why we say accept? For example, cost of capital is 10%. So, this should be rejected because cost is more, return is less. Cost is more, return is less. And here, it should be accepted. Cost is less, return is high. This is called internal rate of return. Students, advantages and drawbacks. Advantages. Cash flow based. Considers full life of project. Considers time value of money. Yes. But it has some quite tricky drawbacks. First of all, it is a relative measure and does not consider size of project. same as that of ARR. Project X and Project Z. There are two projects. They have IRR of 20% and 35%. Based on IRR, we should choose this. But NPV of project X is 22 million and project Z is 4 million. So which is giving more benefit in quantity? This one, size. So IRR is giving wrong decision. You should go for it. Now, so NPV is preferred here. Second, IRR assumes that excess cash flows of project are reinvested at same rate of return equal to IRR. Excess cash flows are reinvested at same rate of return equal to IRR. Now, what does it mean? They say this is excess cash flow. They say it can be reinvested somewhere at this rate. It is too high a return. The same return may not be possible from any other source. Yes, which may not be possible. If IRR is too high, we may not find a similar project, similar investment option with this high return. This is called reinvestment assumption, which is a problem, problematic. Yes. So IRR reinvestment assumption is incorrect. If IRR is too high for a project, we cannot invest its excess cash flows at the same rate. Student, NPV. So here I will discuss one thing. Advantage of NPV. One more. I told you I will discuss. NPV assumes that excess cash flows of project are reinvested at cost of capital, which is more realistic. Only cost is recovered. No high returns expected. That's why NPV is better than IRR. The cost of capital is 10%. Okay, you just reinvest it at 10%. Excess cash flow. NPV assumes that. Third point. For some non-conventional cash flows, sometimes multiple IRRs or no IRR generated. It happens with IRR. When apply the formula, sometime it happened. It has been evidenced. Non-conventional. What are the non-conventional? Sometimes for some non-conventional cash flows, not for all. So non-conventional cash flows are those cash flows What are conventional? Conventional is that there is outflow, then inflow. These are the conventional. First outflow, then inflow. What is non-conventional? Non-conventional is that here is non-conventional. That yes, outflow, then inflow, then multiple outflow within the cash flows. Multiple outflows. So when we calculate IRR of such cash flows, some, not for all, such multiple IRRs. Let me try it. It may give error, but not necessary. I'm telling there are certain cases. Okay, one IRR they have given. Sometimes it gives two IRR in some cash flows. For example, it gives IRR is 15% and 30%. Now, if cost of capital is 20%, now should we accept the project or not? When multiple IRR are there, 2 or 3 or 4. Error with the IRR method. Or sometimes it's an error. IRR cannot be calculated. It happens. There is evidence of it. Now, the next point is the next point is any question so far? So I have discussed it. Then came the concept of MIRR, modified internal rate of return, which is called MIRR, which actually removed all these drawbacks, especially these two, the last one, reinvestment assumption and multiple IRR case. It removed these drawbacks. So same cash flows we can take. This one for which we have calculated IRRs. Okay. MIRR said that you can use any reinvestment assumption. Cost of capital is, for example, 10%. Reinvestment rate, that you will be reinvesting excess cash flows, for example, 5%, 15%, whatever you want. So MIRR is equal to MIRR. Finance rate. First of all, we have to calculate cash flows. Cash flows. Selected, comma, you need to memorize it, this formula. All cash flows, comma, finance rate is the discount rate. Comma, reinvestment rate. Close. We selected all these cash flows, discount rate and reinvestment rate. For example, we say reinvestment rate is company will reinvest excess cash flow at 12%. Okay, we can do that. Simple is that. So MIRR now we can calculate for the same project. MIRR starting from here, comma, finance rate, comma, reinvestment rate. Here you go. Here is MIRR, when reinvestment rate is different. So these two issues of IRR have been solved by MIRR. Anyone, any question, any problem, any issue. Again, if MIRR of a project is greater than its cost of capital, we say accept the project. Now, students, if question is silent, sure. Here it is. The all cash flows. Okay, first one, this one. All cash flows. This is cost of capital. Then it is reinvestment rate. Welcome. So students, yes, if MIRR is greater than cost of capital, we say accept the project. And if it is less than that, reject the project. Simple as that. If examiner is silent about reinvestment rate, then assume cost of capital as reinvestment rate. Means whatever you use discount rate, same will be the reinvestment rate. For example, the question we can pick. This is the question. They said cost of capital is 8%. They didn't tell you reinvestment rate and say calculate MIRR. So how to calculate? MIRR, select all, comma, this, comma, again this. Simple is that, 7%. Here you go. Students, it is complete. So today's task I have completed. Right? And the notes, volume 1. You see here, we have done today's job. Okay? And in the next class, we will be doing NPV adjustments, annuity perpetuity. Very good topics are there in the next class. And dates I will mention, and I will send you, I will update it on the portal. So so the first class, I kept it light, that enough work has. Our classes will be task-based, not time-based. So the next class, we will be meeting for these topics. Okay? And if we do that, of course, and I'll try to touch some, if we have time, I will try to touch some past exam paper as well in the next class. You will get kit as well. So thank you for joining today. See you next week. Till then, take care. Goodbye. Goodbye.